Hello, crypto enthusiasts. I am your crypto trading expert, ready to guide you through the exciting world of scalping in cryptocurrency trading. Now, you may be wondering, what is scalping? Well, in the simplest terms, scalping is a trading strategy that focuses on making numerous trades within a short time frame to capitalize on small price movements. And why is it relevant in cryptocurrency trading, you ask? It's because the crypto market is highly volatile, and this volatility can create numerous trading opportunities throughout the day. Now, imagine utilizing a 15-minute scalping strategy. This approach allows traders to make quick decisions based on short-term price movements, potentially leading to significant profits over time. So, if you're ready to take your trading to the next level, stick around as we dive deeper into this strategy. Before we begin, it's crucial to set ourselves up for success. The foundation of a successful scalping strategy lies in the selection of the right cryptocurrency pairs. Now, you might wonder, what's the right pair? Well, it's those with high liquidity and volatility. High liquidity ensures that your orders get filled quickly and at your desired price, which is vital for a strategy that thrives on speed and precision. Volatility, on the other hand, provides the price swings needed to make a profit within a short time frame. So, focus on popular cryptocurrencies such as Bitcoin, Ethereum, or Ripple that typically have high trading volumes and price fluctuations. However, remember that the crypto market can be unpredictable. So, it's always a good idea to keep an eye on the market news and be ready to adapt your strategy according to the market conditions. Next, let's talk about the tools of the trade. To implement the 15-minute scalping strategy effectively, you need a trading platform that supports 15-minute candlestick charts. These charts offer a visual representation of price movements within a 15-minute time frame, making it easier to spot trends and patterns. Moreover, these charts can help you understand the market sentiment. For instance, a long bullish candlestick indicates strong buying pressure, while a long bearish candlestick signals strong selling pressure. This information can be invaluable when deciding when to enter or exit a trade. When choosing a trading platform, look for one that offers real-time data, various technical analysis tools, and a user-friendly interface. Some popular choices among crypto traders include Binance, Coinbase Pro, and Kraken. To sum up, setting up for scalping success involves selecting volatile and liquid cryptocurrency pairs and using a robust trading platform that supports 15-minute candlestick charts. These two elements combined can significantly increase your chances of success in the fast-paced world of scalping. Remember, the right setup is half the battle won in scalping. Now let's get technical. Knowing your indicators is key to mastering scalping. In the realm of scalping, especially when we're talking about a 15-minute strategy, certain technical indicators are our best friends. They provide the insights we need to make rapid, informed decisions. Firstly, let's talk about moving averages. These are used to identify potential trends by smoothing out price data. The two types we will focus on are the simple moving average, or SMA, and the exponential moving average, or EMA. The SMA gives equal weight to all data points, while the EMA gives more weight to recent data. These averages can help us identify the direction of the trend. Next up is the Relative Strength Index, or RSI. This momentum oscillator measures the speed and change of price movements. It oscillates between 0 and 100, and a cryptocurrency is generally considered overbought when the RSI is above 70 and oversold when it's below 30. It can help us identify potential reversal points. The Moving Average Convergence Divergence, or MACD, is another friend of ours. It's a trend-following momentum indicator that shows the relationship between two moving averages of a cryptocurrency's price. The MACD triggers technical signals when it crosses above to buy or below to sell its signal line. Lastly, we have the Stochastic Oscillator. This indicator compares a cryptocurrency's closing price to its price range over a certain period of time. It generates a value between 0 and 100 and is used to identify overbought and oversold conditions. Setting up these indicators on your trading chart is straightforward. Most trading platforms have these built in, and it's usually as simple as selecting the indicator from a list and adjusting the settings to fit your strategy. Interpreting these indicators, though, requires practice. It's about recognizing patterns, understanding what the indicators are telling you about potential price movements, and making quick decisions based on that information. With these indicators, we can make informed decisions about when to enter and exit trades. Remember, in scalping, every second counts, and the right indicators can give you the edge you need. Having our indicators in place, it's time to identify our entry and exit points. This is where the rubber meets the road, where we put our analysis into action. So, let's dive right in. First, let's talk about entry points. These are the moments when you jump into the market, initiating a trade. But how can we spot these moments? Well, our indicators will be our guiding light. For instance, when the price line crosses above the moving average line, it's a strong signal to buy. Similarly, when the relative strength index, RSI, dips below 30, it suggests that the asset is oversold and could be due for a price bounce back, another buy signal. But remember, these indicators aren't infallible. They're tools, not profits. That's why it's essential to consider other factors like support and resistance levels, trend lines, and price patterns. Support and resistance levels, for instance, can help us anticipate price reversals. When the price drops to a support level, it's like hitting a floor. It's likely to bounce back up, making it a good entry point. Now, on to exit points. These are moments when you should close your position to either secure a profit or prevent further loss. If you've entered a buy position, you might look for an exit point when the price line crosses below the moving average line, or when the RSI climbs above 70, hinting at an overbought condition. But again, don't rely solely on these indicators. Keep an eye on resistance levels, trend lines, and price patterns. If the price rises to a resistance level, it's like hitting a ceiling. It might soon fall, making it a good exit point. Remember, the goal of scalping isn't to win big on a single trade, but to make small, quick profits consistently. So, don't be afraid to exit a trade once you've made a decent profit, even if you think the price might still go up. It's better to secure a small profit than risk losing it all. Mastering entry and exit points is a crucial step towards successful scalping. It's a skill that requires patience, precision, and practice. But once you've got it down, you'll be well on your way to becoming a proficient crypto scalper. In the world of trading, managing your risk is just as important as identifying profitable trades. In our pursuit of quick profits with a 15-minute scalping strategy, we must never overlook the need for robust risk management. Let's begin with stop loss and take profit levels. These are our safety nets. A stop loss order limits your loss if the market doesn't go in your favor, while a take profit order ensures you lock in your gains when a specified profit level is reached. By setting these levels, we can step away from the screen, knowing our risk is under control. Now, on to position sizing. This is the process of determining how much of your capital you're willing to risk on each trade. It's a critical step in managing the potential downside. So how do we do this? First, you need to determine your risk tolerance. This is a personal decision and can range from 1 to 3% of your total account balance. Once you've determined this percentage, you can use it to calculate the dollar amount you're willing to risk on each trade. For example, if you have a $10,000 account and you decide to risk 2% on each trade, you're willing to lose $200 if the market goes against you. That $200 becomes your guideline for setting your stop loss order. Remember, successful traders aren't just those who win trades, but also those who effectively manage their losses. Now, we move from theory to practice. Let's walk through a live trading example. Imagine we're trading on a popular cryptocurrency pair. The first step in our 15-minute scalping strategy is to identify potential entry points. We'll use our technical indicators, starting with the moving averages. When the short-term average crosses above the long-term one, that's our cue to consider entering a trade. But we don't jump in just yet. We also check the Relative Strength Index, or RSI, to make sure it's not indicating an overbought condition. And we look at the MACD and the stochastic oscillators to confirm the trend. Once we're confident about our entry point, we place our trade. But remember, risk management is crucial. So we immediately set our stop loss and take profit levels. The stop loss level is usually a few pips below the entry point, providing a cushion in case the market moves against us. The take profit level, on the other hand, is a bit above the entry point, allowing us to lock in profits when the market moves in our favor. As we monitor the trade, we don't let emotion sway us. We stick to our strategy, knowing that the indicators and levels we've chosen are based on sound analysis. And there you have it, a live demonstration of a 15-minute scalping strategy in action. Before we wrap up, I want to share some tips for success and common mistakes to avoid. When it comes to mastering the 15-minute scalping strategy, there's more to it than just understanding the technicals. The most effective scalpers are disciplined and patient, not simply reactive to the market's every move. Remember, the goal of scalping is to make small, quick profits. So, avoid overtrading. It's easier to maintain control and stick to your strategy when you're not constantly in the market. Don't let greed or fear dictate your trades. Instead, make decisions based on your analysis and stick to your predefined entry and exit points. If a trade doesn't fit your criteria, it's better to skip it than to risk a loss. Now let's talk about some common pitfalls. One of the biggest mistakes traders make is not adhering to their strategy. If you've done your homework and developed a solid plan, trust it. Don't second-guess your decisions mid-trade based on fleeting market movements. Consistency is key to long-term scalping success. Another mistake to avoid is risking too much on a single trade. It might be tempting to go all in when you think you've spotted a perfect opportunity. But remember, even the most promising trades can go south. It's important to manage your risk and diversify your trades to protect your capital. And finally, don't forget to monitor your emotional state. Trading can be a roller coaster of highs and lows, and it's crucial to keep your emotions in check. If you find yourself feeling stressed or anxious, take a break. Clear your mind before you make any hasty decisions that could impact your trading. Remember, successful scalping is a combination of strategy, discipline, and effective risk management. It's not about making a fortune overnight, but about small, steady gains that accumulate over time. Keep these tips in mind and avoid these common mistakes, and you'll be well on your way to becoming a proficient 15-minute scalper. Remember, successful scalping is a combination of strategy, discipline, and effective risk management. Oh, we've covered a lot today. From understanding scalping to live trading demonstrations. We've dived into the nitty-gritty of the quick-paced world of scalping in cryptocurrency trading, highlighting the potential of a 15-minute strategy. We've explored the importance of selecting suitable cryptocurrency pairs, the role of dynamic technical indicators like moving averages, RSI, MACD, and stochastic oscillators, and the art of identifying entry and exit points. We've underscored the significance of risk management, setting stop loss and take profit levels, and calculating position size based on risk tolerance. We've also walked through a live trading demonstration, putting theory into practice, and not forgetting the valuable tips for success and pitfalls to avoid. Remember, practice makes perfect. So, start by applying these strategies in a demo account before venturing into real trading. Thanks for joining me today. Don't forget to like, comment, and subscribe for more trading tips and strategies. Until next time, happy trading.